Steve, thank you so much for joining us today. How are things in Baltimore?
Well, fall weather is setting in finally. Leaves are starting to come off the trees, and finally fall. How about
Yes, I love this time of year. So, is the National Guard patrolling the streets of Baltimore, or is that only in DC?
well that was in D.C. I think they've knocked that off in D.C. Trump has threatened to send the troops into Baltimore, but so that's kind of died out. That was a uh, kind of a hot point for a few days, and then for some reason Trump backed off.
So, I want to start a conversation by asking you what your views are on the U.S. economy as it sits right now.
My view is that I think it's going to slow down and get into troubled waters, but it hasn't remarkably it hasn't done so yet. I mean, if you look at the market, for example, and market participants, whatever this stupidities being emitted from Washington D.C. in terms of economic policy, especially tariffs and the blatant intervention that the White House has taken in all kinds of businesses, industries, and so forth. They've politicized virtually everything and intervened in all kinds of things. I mean, down to the point if they don't like some CEO of a company, if Trump doesn't, he calls to get him fired, for example. So there's this micromanagement of everything going on. That all of that should have shaken the markets and slowed things down. Hasn't done so far, and we still have anemic monetary growth. I think monetary policy is too tight. So I anticipate a slowdown, but it really hasn't affected the markets yet. Whether it's foreign wars, whether it's trade wars, whether it's all kinds of activity and intervention in industry, the market just seems to ignore it. I mean, we're now almost, we've got the government actually shut down in the United States. Maybe that's a good thing because actually every time Congress is in session, I get pretty nervous.
A big part of what's driving this market right now is this AI. And I recently had a discussion with Juliet, the clerk. She thinks the US economy is at risk for serious job displacement due to AI. And she thinks the youth unemployment of 10% is the beginning of that. And the CEO of Anthropic recently said that AI will eradicate entry level jobs by 50% in the next 5 years. He also said he sees the unemployment rate going to 20%. What are your thoughts on this?
Well, I think there'll definitely be some displacement in certain sectors. Yet yesterday, Amazon just announced that they were going to have a huge robotic replacement of that will eliminate lots of jobs. But Amazon's the kind of environment that it's kind of business where robotics it's a natural. So that in certain sectors, I think it will be very significant. Yes.
And do you see the unemployment rate going to 20% in the next 5 years? I mean, that would be devastating.
Yeah. Well, for 20%, what overall? No,
Yes.
no, no. It's nonsense. I think for some entry level jobs, that might very well be true, but the overall rate at 20% is, I think, an absurdity. That gets into the whole zone of the idea that AI is going to increase productivity and the growth potential in the United States tremendously. That's just nonsense. That's Silicon Valley talk. What I call silly valley. That's silly valley talk. So whoever said this 20% number is probably from Silly Valley.
Yeah, he's
And
the CEO of Anthropic.
yeah, well, it has never looked at any economics or economic history But with AI, people become kind of brain dead. That's one of the big liabilities of AI, and I've noticed this with students, by the way, at the university. I mean, I'm at Johns Hopkins, one of the original research university in the United States, by the way, a very select group of students. And AI, I can see the ones that I have that use it, and I know them very well and can watch, and it tends to dull their brain. And it's very difficult for them to use because if you ask AI stupid questions and unstructured questions and you don't know a lot about the subject, you get stupid, unstructured, false information from AI. In other words, it can be very helpful. You can use chat, for example, and it can be very helpful. It can save a lot of time if you know exactly what to ask. But young people typically don't. I mean, most young people at the university now, they've very few have even read a book besides a textbook. Yeah, they've read a textbook. The reason they've read a textbook is that they have to take an exam, and they know how to. At least at Hopkins, they know how to take it. They know how to study for an exam, take an exam, get a very high score on an exam. They know all of that stuff, but the wider reading they don't know, and they don't know how to even read a newspaper properly.
Just
You
because we're on the topic,
you give these young people a newspaper and tell them to read an article and tell you what the main point is in the article, and they'll have the thing so upside down. They just make confetti out of the whole thing. I mean, it's ridiculous. So I'm a little bit skeptical about certain aspects of AI, but the kind of robotics aspect, like the Amazon thing, it's obvious and it's real because why? Amazon, anything that's running on an assembly line basis, where there's kind of no thinking really involved in the thing, it's ideal for robotics or AI.
and Steve, just because we're on the topic of AI, we got to talk about valuations. And I recently read a report from research firm MacroStrategy. They said they calculated that this bubble, the AI bubble, is 17 times larger than the tech bubble of the late 1990s. And Paul Tudor Jones recently did an interview on CNBC. He said that the ingredients are in place for a massive rally before a blow off top. Once again, he made references to 1999 and 2000. What are your thoughts on valuations and where do you see this market going and what's going to be the catalyst to pop the bubble?
Well, first of all, we are in a bubble. I have something I call Dr. X's bubble detector, which I've written about in Forbes, National Review, Fortune magazine. Dr. X's bubble detector. You just Google a thing, and we are in a bubble. There's no question about that. So, and why are we in a bubble? Well, what is a bubble? The bubble detector looks at the amount of wealth or purchasing power required to buy yield in stocks and bonds. And right now, the stocks require a lot more wealth to buy a unit of yield than the amount of wealth required to buy a unit of yield in bonds. So there's a big so that's why you have the bubble. The stocks are very, very overvalued relative to bonds, and those are the two big asset classes. So we are in a bubble, and it's a little higher than the dot-com bubble now. Not 17 times, but just it's more or less on par, shall we say? So that's my bubble detector. So the question is, well, you don't stay in a bubble forever. and bubbles can pop, but you can't predict when they're going to pop or whether they'll pop. Maybe the bubble won't pop, Jimmy. Maybe the air will come out of the thing just slowly, and you come down to kind of more normal valuation levels. So it can pop and boom, overnight you're back down to normal levels, or it can just seep out over time. So you don't know whether it's going to pop or seep out. And you said, well, what's going to trigger it? I don't have a clue. Right now, no matter what happens, it isn't triggering anything. No, the market doesn't react to anything in a, shall we say, a negative way. Or if it does, it's very temporary. It'll last for 24 hours or 48 hours, and then right back up going forward. So that's my take on the thing. So the only thing you can recommend is a lot of people say, well, Hanke, you say we're in a bubble. Should I get out of the market? And I say, no, you shouldn't get out of the market, because that usually does, that requires two decisions. The decision to get out, and then you got to make another decision about timing and when to get back in. So that two-step process historically never really works out very well. So the answer to that is no, I wouldn't get out. But what would you do? Well, I'd rebalance my portfolio a little bit. If you have a normal portfolio, the standard plain vanilla 60-40, 60 stocks, 40 bonds, that and you had that, let's say in 2020, 5 years ago. Right now, that thing is probably up at 85-15 instead of 60-40. So you might want to trim down some of the things in the stock portfolio that you don't particularly like or don't have a good feel about, to get things more balanced to whatever your ratio was that you're comfortable with.
I'd love to get your views on the level of speculation we're seeing in this environment. Um, I had a discussion recently with an ETF manager, and he was telling me in a 1 week period there was 200 funds that filed for ETFs or new ETFs that have 5 times leverage. And I was really shocked to hear this. And then he said the other big thing that's happening within the ETF world are ETFs on single stocks. So AMD, for example, or Nvidia, you might get 3 times or 5 times leverage on these things. But it's just not ETFs, it's everywhere. I had a discussion recently with a Bitcoin portfolio manager, and he was talking about these perpetual futures. I've never heard of them before, but he said it's quite common. A lot of the trading going on with the Bitcoin market is with these perpetual futures, and they have 50 to 100 times leverage. And but we see it everywhere. I mean, look at the meme stocks. Like Beyond Meat was up, I don't know, 1,000% in a few days. What are your thoughts on this? And do you think this is another sign that we're in a bubble?
Well, I think we're in a zone of stupidity. Everyone, I mean, that kind of leverage, it just blows your mind. I mean, in the old days when I was involved with a hedge fund, you know, this is a hedge fund trading foreign exchange and commodities, and advertised as, you're getting into a speculative zone in your portfolio. And we would explain this to clients. I mean, this is what this was some years ago, when derivatives and futures and options and everything were pretty exotic for most investors, and a leverage of 3 was considered pretty high. That was with a hedge fund. Now you've given numbers that are way beyond that, for all of these things. So I'd say it's the height of stupidity.
Have you ever had one of those Beyond Meat burgers?
No,
Yeah, they're awful. They're awful.
that's why I haven't had them.
You got to load it up with ketchup and mustard. to overcome the taste. So I want to move on now and bring up another topic that you're well acquainted with, and that is gold. Gold is having its best year since the 1970s. It's up over 50%. Many of the gold producers are up 100, 200% on the year. They really came alive in the second half of the year. What's your take on gold here? We've seen a little bit of volatility in the last few days, but do you still think gold has a long way to go?
Yes, I think on September 21st I did an interview, and at that time I indicated with quite a bit of arm twisting. Finally, they said, "Well, where do you think it's going to peak out?" Knowing that I'm long and a gold bull, and I said it'll peak out at about 6,000 an ounce. And so then the question is, well, how in the hell did you get that number? And my calculation is, again, I like fairly plain vanilla type things, not too complicated. So if you look at the last big bull we had was 79.80, the secular bull in gold, and it peaked out at a gold price of about 10% of the disposable personal income per capita in the United States. So find the number for the disposable personal income per capita in the United States, take 10% of it, and you get, about around a little over 6,000, but let's keep even numbers, 6,000. And had a huge pullback, and as the day it pulled back, I said, we're getting into a very inviting territory to add to your position, and now it's gone up a little bit. But if you look at the price, by the way, from September 21, I know correlation doesn't imply causation, but after I said that, the market took off. And I think, I can't remember now, but I think it was up, like, after I spoke, it went up, it peaked out before this latest correction. It was up about $700 an ounce.
I'm also a big believer in gold. My only concern is I'm not sure if you saw the interview with Jamie Dimon. He actually came out and said that this is one of the few times in his life that it's semi-rational to have an investment in gold. He also went on to say he could see gold going to $5,000 to $10,000 in this current environment. But as we all know, he hasn't had the best track record when it came to talking about gold or Bitcoin. So that's my only caveat with the gold right now.
Yeah, I'm pretty relaxed about it.
So you made mention of the fact that gold peaked out. The last time we saw it peak out was in the 1980, I think. Had a massive move. And Ray Dalio recently said that he thinks this current time is very similar to what we saw in the 1970s and early 1980s. And when you talk about the 1970s, it was a crazy time. I mean, we saw Nixon take the US dollar off the gold standard in early 71. We had the Yom Kippur War in 73. That led to the oil embargo, where we saw the price of oil go from $3 a barrel up to $12 a barrel in a relatively short period of time. And on the back of that, we saw inflation run up to 12 or 13%. And as you mentioned, gold also ripped from like $100 an ounce in 73 up to over $800 in 1980. Do you think this time period we're going through right now, do you see any similarities between now and the 1970s?
Oh, I see quite a few. The one thing now that is different, I would list at 30,000 feet. I characterize it by something we talked about earlier, and that is everything has become politicized. The politicians have their fingers in everything, so they're going to screw up all kinds of things. We're moving away from free market economics into an interventionist zone, and that interventionist zone actually is something that's all outlined in the Communist Manifesto. So all of this populism and that we see, and it's particularly pronounced in transparent in Washington, D.C., but it's every place. Everybody's doing the same thing. I mean, actually, it's kind of interesting and ironic. Now you have who's embracing free international trade? The Communist Party in China. Who's against it? The so-called conservative free market people in Washington, D.C. It shows you how screwed up the world is. So whenever the world's screwed up, gold goes up. You have a rich environment for people to go into gold as an asset class. And there's another factor that we didn't have earlier on, and that is this constant drip of de-dollarization. You know, Trump has made so many enemies of the United States. He can still hold a whip handle and whip them into shape, more or less, but behind the curtain, they don't like it.
And Steve, one of the major themes that we saw in the 1970s was stagflation. Uh, Inflation out of control, but we had a slowing economy. Do you see that happening now?
Not not really. I think there's too much talk about stagflation. I see the business stagflation was a secular thing that lasted for a long time. The structure of the economy was had changed, and the slowdown became kind of embedded. It wasn't really a cyclical thing, but the growth potential just came down. And the one reason the growth potential came down was a lot of overregulation of the economy and a lot of interventionism in the economy. So maybe now that I'm talking off just talk shop here, if the interventionism continues, then I would say the growth potential is going to be drugged down, and there is a potential for stagflation, but it isn't here yet because the inflation part of the thing is not really in the picture. The money supply is now contracted and anemic, so inflation just isn't right around the corner. That's not in the picture the way it was in the 70s. So we had a lot of overregulation, tamping the economy down and lowering the potential growth rate in the economy. But at the same time, you had the central banks trying to goose things to make it go, and that was creating inflation. So you had stagflation. You had lower potential growth and higher inflation. Now we got kind of a tug of war. We've got the interventionism part that's dragging the economy down, but we have a lot of innovation with in fact things like AI. I mean the AI boom, which offsets the down drag a little bit. We don't know how much, but it's not going to be as much as the AI people advertise, by the way.
You are also well acquainted with the Canadian economy, and I want to ask you about one of your favorite prime ministers, Mark Carney. He's been in power now for 8 months. What are your thoughts? How's he doing so far? Or is it too early to tell?
Uh, I think he's, as you know, Carney really isn't my cup of tea, and the Liberal Party policies aren't my cup of tea either. But I would say I'd give Carney pretty good marks. Let's put it this way: he's been able to dodge the bullet. I don't think he's done anything very positive, but he has been able to dodge the bullet. And if the bullet would have hit, it would have really been bad for Canada. Canada is just in bad shape, basically. Productivity is very low. Potential growth is low. I read that retail sales are sluggish, and it's kind of a sick economy, basically. and that's been due to 10 years of the liberals. I mean, 10 years of socialism will do a job on you.
Extreme socialism.
Well,
So,
it can get worse. I mean, I hate to end on such a negative note, but at any rate, I give Carney credit for dodging the bullet. I mean, he's I think he's done pretty well.
yeah, I have to. I didn't vote for the guy. My view is the liberals were in power for 10 years. If they couldn't get it right over those 10 years, they don't get another chance. But the majority of people did, so I accept that. I will say he's definitely brought a new level of professionalism back to the prime minister's office. And I think he's respected by many leaders throughout the world. So, from that point of view, I think he's done a
Oh
great
yeah,
job.
I agree. I don't agree with him, but I do respect him. He's
And
he's he's not running a clown show up there anymore.
yes. And you were talking about the weakness within the Canadian economy, and it's in rough shape. I got to tell you, our unemployment rate right across the country is at 7%, Steve. In the province of Ontario, where I reside, it's at 8%. In the city of Toronto, it's at 10%. We just had a couple of Stellantis, one of the largest car manufacturers in the world, just announced that they're pulling out of southern Ontario and they're moving to the state of Illinois, where they plan on spending, I think it was $13 billion over 4 years. And that's going to result in 5,000 additional jobs in the state of Illinois. So in southern Ontario, we're losing 3,000 jobs. And General Motors just announced that they're shutting down a plant here in southern Ontario. This particular plant was used to make EV vans, and they were hoping they were going to sell thousands of these vans to FedEx, UPS, Amazon, etc. Apparently, it's been a total bust. They're shutting it down. So 12 or 1,300 people are losing their jobs there. So the auto industry, which is quite a large industry in southern Ontario, is coming under attack.
Well, it doesn't surprise me, but it's bad news.
Yeah. So, listen, this has been a great discussion, Steve, and I want to thank you very much for spending time with us today. If somebody would like to follow you online, you're very active on Twitter or X. What's your handle?
At Steve_Hanke.
And how many followers do you have now?
808, little north of 808,000.
Well, we got to help to get you up to 1 million.
Absolutely. That'll make my day. We'll have to have a special interview when we hit 1 million.
Yeah, I'll come down to Baltimore and we'll do it in person.
Yeah, absolutely. Yeah, be good to see you down here again.
Steve, once again, thank you.
Thank you. See you, Jimmy.